Lately, we've all been experiencing stock market swings, record inflation, and rising interest rates.
And seeing this may make you wonder, can I still retire?
But you don't have to just sit back and watch. What you can do to take control over your retirement right now on Retiring Today.
Welcome to Retiring Today. I'm here with Haley Gutchenreiter and Lauren Merkle. Haley is an investment advisor representative, and Lauren is a certified financial fiduciary, a certified financial planner, and a retirement income certified professional. And you guys are seeing the storm that's happening around us, inflation, interest rates, and the stock market. But Lauren, people still want to retire even though all of these things are happening.
Yeah, that's the one thing that doesn't change amidst all these changing winds in the storm is you still want to retire. If a year ago you were planning on retiring in 2 years, that probably hasn't changed, or you certainly don't want that to change just because now we have inflation problems and we have interest rate increases and the market is plummeting down. You don't want your retirement lifestyle to be impacted by all these external factors that nobody can control.
Okay, let's set up the storm just real quick. People have watched it, but just in case you're wanting a little bit of a reset of what's been happening. Inflation, Haley, the latest numbers are at record highs.
Yes, it's the highest we've seen since the 80s. So you can definitely feel it in your wallet every time you go out to fill up your gas tank or you go out to go buy groceries. Inflation is high, which is eroding the purchasing power of the dollar. And it's really that silent, we used to refer to it as a silent assassin, right? If you had funds at the bank, then we would say you're safely losing money to inflation. You just don't know it because you can't feel it. But when it's at these all-time record highs, you can most definitely feel it.
Yeah, another thing that happens that we feel later down the line is when the interest rates jump, and they went up for 3/4 of a percentage point for the first time in a really long time, Lauren.
Yeah, they sure did, and that's going to continue to take place that way. We've seen it for the last 12 months continue to increase, and that has an impact not only on what the items when you take out a loan, whether you're getting a mortgage or you're buying a car, but it also has an impact on the stock market. So it impacts a lot of different factors that will directly impact you in your retirement vision.
Yeah, and that third piece of the storm, the stock market, you can call it a slump, you can call it a bear, but you can call it what you want, but people are watching it go down.
Yes, most indexes are down over 20%. So it's definitely a bear market environment. It's not what retirees and pre-retirees are wanting to see as they are either in retirement, taking income from their portfolio, or if they're nearing retirement. But that's why it's so important to come back to the plan, to come back to the overall plan, because you want to be prepared in these types of environments so that your lifestyle doesn't have to change with the ups and downs of the market.
And that's one of the most important takeaways of this show is that even though all these things are taking place, you can still retire if you have that plan in place. And when we see the stock market do what it is doing this year, that doesn't necessarily have to be a bad thing if you have the plan in place, and that plan should include specific strategies that you can implement in times like this, so when we come out of this, because we always do, when the market's down, it's always come back up. So we're going to see that again. But you want to put yourself in a better position when we do come out of it, and it's these strategies that can really help out.
So today we want to give people some strategies, some things that they can consider, talk to their retirement planner about, be thinking about, because you don't have to be necessarily a victim to some of these economic conditions that you're seeing around you. So the first one, Haley, is rebalancing your 401k. What does that look like?
Yes, so this is if you're still working and you're putting money away within a 401k plan. So this is for your existing allocations underneath the 401k. And as a reminder, the 401k is very limited on the options that you have. Primarily, you're going to have some stock options, some bond options, and then maybe a stable value or money market fund. And the issue that we're seeing with bonds is it's an interesting topic because right now with the interest rate environment that we're in, bond prices are going down. Year to date, bonds have been down anywhere between 12 and 20%. So if we have a high level of confidence that bonds are going to continue to lose money over time, what can we do with this portion of our 401k to take advantage of the environment that we're in? And one thing is we can get out of bonds. But if we get out of bonds, we have to put that somewhere else. So if your 401k plan has a stable value fund, that is a way that you can hedge yourself against the downside risk of stocks but then also get a reasonable rate of return that's offering you more than what the banks are, maybe somewhere over 2%. But again, this is just a strategy. It doesn't work for everyone, so make sure this works out in your plan.
Yes, so go ahead, Lauren. I would say if you're watching this at home, you like this idea, how does this execute inside a 401k?
Yeah, really there's a couple different ways you can execute what you just talked about, Haley. One is you can call your custodian. So wherever your money is housed, you can call them, you can tell them exactly what you want to do. They can facilitate that for you, or you can log online and you can go through the different prompts that they offer you through the online system and get it done that way. But you said it really well. Any of these strategies that we talk about here today are not strategies for everybody. They may not work for you. They may not be the best for you. And before you do anything, make sure you construct your retirement plan that has your income plan, your tax plan, your healthcare plan, your investment plan, as well as your legacy plan, all built, because the decisions you make with your investments could have a direct impact on what you're trying to do from an income deliverance standpoint, taxation standpoint. All these things are interrelated. So what's good for one doesn't necessarily mean it's good for you. We need to make sure that plan is built first.
So another thing to consider is doing something different with your new contributions. Again, we're talking about the 401k.
Yes, and let's clarify, because what I was talking about previously was for your existing money in the 401k plan. For your new contributions, that's new money going into your 401k. So every time you get a paycheck, a portion of that paycheck is going to get invested into whatever you're allocated in within the 401k plan. And right now, when the market is down between 20-30%, that is a 20 to 30% discount that you could take advantage of with those new contributions. So it would be our recommendation that you get aggressive with that if you have the appetite, because if you can take advantage of that discount in the market and then ride that upswing when it recovers, that's gonna fare you really, really well.
Which seems really contrary to what most people are thinking right now, because every time you turn on the TV, it sounds like it's kind of a doomsday scenario. We don't know how bad it's going to get, but that happens every single recession we go through. The worst part about these bear markets or the recessions is nobody knows how bad this is going to get. But what we do know is if we have a 30% discount right now, and you put your money into stocks in a very strategic way, and if the drop goes down to 40, well, yeah, you lost 10% or so on that contribution, but then you get all of that gain on the way back. And with that strategy that you outlined, it can work really well for some people, because the maximum amount that you can put into your 401k plan on an annual basis, if you're 50 or older, is $27,000. So if you have $1 million retirement portfolio, we're talking about $27,000 that you're systematically putting into a discounted stock market, which can work really well for you when we come out of it, and it shouldn't increase your overall risk in your portfolio that much.
So any of these strategies we're talking about, we know that they're specific to your situation. So maybe you have some questions about your 401k. Here is a great opportunity. It's a 15-minute complimentary retirement checkup call. You can talk directly with a retirement planner during this call about this market and what to do. So go to merkleretire.com, schedule your 15-minute retirement checkup call today. We'll continue talking about how to retire in a down market when Retiring Today continues.
Biking, boating, relaxation? What's your retirement vision? Learn how to take the money you've worked so hard to save and turn it into the retirement of your dreams during our Journey to Retirement workshop. Like getting ready for a trip, getting to and through retirement takes a roadmap. This workshop is the first step to planning your 20 or 30-year vacation. Go to retirewithmerkle.com to register for our Journey to Retirement workshop this week.
Anytime I have even the smallest question about my accounts or what effect the latest tax law might have on my situation, the Merkle Retirement Planning Team is always there and quick to help. I'm so glad they treat you like family. I'm so happy to have such an excellent team working for my future and ensuring I do the best to achieve my financial goals.
Merkle Retirement Planning. Your retirement starts here.
Welcome back to Retiring Today. We're talking about this down market and what to do if you are retired or want to retire. So let's go to those who are retired. They don't have to be a victim to this stuff, this inflation, this market, this interest rate. There's some action steps that you can take.
Yeah, nobody has to feel like they're a victim to this stuff that we can't control, but sometimes when you're retired, some of the strategies, like the strategy Haley talked about, where you can change where your new money's going, well, you don't necessarily have new money going anywhere. You have this pot of money that now you have to live on for the rest of your life. And every time you log into your IRA balance or your 401k balance, you see it go from whatever it was and now it's substantially less. And that feels like a really scary experience, because it is a really scary experience. But here's some strategies that you can take advantage of even though you're retired and you don't have new money going into your plan. The first strategy is a lot of retirees have a portfolio that looks like a 60% stock or 40% bond portfolio. And if this looks anything like you might have a 70% stock, 30% bond, whatever it is. If it's close to this, one of the strategies you can implement is decrease your bond holdings. So Haley talked about how we have a pretty high level of confidence that bonds are going to continue to lose money over the next 12 to 24 months. So if this is an asset class that we have a high level of confidence that's going to continue to go down, one of the strategies you can do is decrease your holdings in bonds and shift over to stocks. And if this is a strategy that you implement, the bonds, number one, did their job because they are down right now, but they're not down as much as stocks. So they did work in a way of insulation from the equity downside. But the other thing is you can take that money that didn't lose as much and take advantage of a 20 to 30% discount in the stock market. So again, if the market even continues to go down further, great, you didn't take the full hit, and then when the market does come back up eventually, whenever that is, you will get all the upside of the money that you put into the stocks. So that's an idea. Another idea is you can use what's called a fixed indexed annuity. And so you can eliminate all or a substantial portion of your bond portfolio, and you can incorporate what we call a bond alternative. And a bond alternative is just some kind of other safe investment that is different from bonds, because again, we think bonds are going to continue to lose money. So you could use something like a bank product, like a CD or money market, but those really aren't paying a whole lot right now either. So a really good alternative for some people in some cases would be a fixed indexed annuity. Now that's a new concept for a lot of people. Many people are not familiar with what a fixed indexed annuity is, but to be real simple with it, basically what it is, it's an annuity offered by an insurance company that guarantees against principal loss. So if the market goes down, you get a 0% rate of return, you're happy, you didn't lose anything. If the market goes up, then you get a piece of the up. Now there's a whole bunch of different types of fixed index annuities, so you want to make sure if you're incorporating that strategy, you use the right one for you, for your situation, but the concept itself can work really well.
And it's very appealing to our families because essentially what this fixed index annuity is doing is you get the upside return potential of the market because the money in that account is tied to an index. So take the S&P, for example. And if the S&P went up 20%, well, you get to participate in a piece of that upside return. So you get the upside potential of the market without taking on any additional risk, which can be very, very appealing for people who are in this retirement phase of life.
You don't get all 20, right? There's like some kind of a cap typically on these of what percentage of the up you get.
Yeah, most of these are going to have some kind of cap, and the caps work different depending upon the insurance company that you use, and the caps can change from year to year too. So again, this is another strategy you don't want to just go out there and do. You want to make sure it's a part of your plan, and you want to make sure you have a really good working knowledge of how these annuities work, because not all annuities are built the same, and most annuities, like most investments, are not investments that are going to be right for you. You want the right annuity in the right circumstance. But one of the strategies, the other benefit by incorporating something like the fixed index annuity is when the market does go down, you didn't lose anything on that portion, and with a lot of these, you can take 10% out per year. So what you would do is you didn't lose any money on this piece, take 10% out, put it back into stocks when the stocks are at a discount. And then you can be real surgical with what stocks you're buying because, again, you didn't lose any money on this piece and you're buying it. So it's a way that retirees can take advantage of a dollar cost averaging strategy when you no longer have new money going into something like a 401k plan from earned wages.
But besides the dollar cost averaging strategy, it works really, really well if you're taking income from your investment portfolio in retirement, because again, this is a piece of the portfolio that's lost nothing. And let's say you need $20,000 to $40,000 a year for whatever reasons, well, you can take it out of this fixed index annuity knowing that you didn't have to sell at a loss.
Yeah, so there's a lot of flexibilities with it in different environments, different economic environments, because again, you don't have to use a fixed index annuity. You could use a CD at the bank because the CD is guaranteed. Unlike the annuity, it's FDIC insured, so that CD can work too. The problem is with the CD in this environment is you are losing money versus inflation because the banks just aren't paying us that much. Where the FIA, the fixed index annuity, gives us a lot more upside than what the bank will provide us.
What about the liquidity on an annuity? Can I get to the money right away, or is there some, I've drawn on some terms we've talked about over the years, I gotta hold on to it for a certain amount of time before I can spend it?
Yeah, go ahead.
So there's typically trade-offs to any investment decision you make. And when you're looking to make an investment choice, you're gonna look at the return potential, you're gonna look at safety, and then you're gonna look at liquidity. And liquidity would be the constraint behind the fixed index annuity, because you can only take up a portion, like 10% out each year, and then after a period of time, it's accessible. So a fixed index annuity in this case would give you the return potential, it gives you safety, but then there are constraints on the liquidity.
Yeah, which is why you want it to be a piece of your portfolio. You don't want it to be all of your portfolio or too much of your portfolio. Just like any other type of investment, you don't want all of your money in this stock or most of your money in this stock. You want to make sure you're really diversified, and that is true when you're talking about strategies like a fixed index annuity.
Okay, that's just one strategy to consider when it comes to retiring, or if you're already retired in a down market. We'll continue talking about some of the things you can do when Retiring Today continues.
The Merkle Retirement Planning Team provides personable and professional expertise unrivaled in this area. They include us in every step of the planning process. The peace of mind provided to us by the Merkle team allows us to fully enjoy this special time of our lives. Instead of feeling snakebit, we feel confident that with the Merkle Retirement Planning Team at our sides, we can navigate any challenge that comes our way.
Merkle Retirement Planning. Your retirement starts here.
Has the recent market volatility put your retirement plan to the test? See if your retirement is still on track by scheduling a retirement checkup with Lauren Merkle. During this 15-minute phone call, we'll discuss if your retirement plan could be disrupted by long-term market volatility. We'll also analyze your current tax plan and provide strategies on how to take advantage of the market. Go to merkleplan.com and click Book Now to schedule your retirement checkup today.
Welcome back to Retiring Today. I'm here with Haley Gutchenrider and Lauren Merkle. So, you want to retire in a down market? What are some things you can do to take control? Haley, another action step, or something at least to consider, is a Roth conversion.
Yes, Roth conversion. So this is where your investment plan meets your tax plan. So what a conversion is shifting pre-tax money over to an after-tax account. And there are very few things that the government will let continue to grow tax-free, which would be a Roth IRA. So that can be the benefit of Roth IRA, is that all the money that you pile into a Roth is going to grow tax-free, which can be to your advantage later on, especially if taxes go up. So the benefit of doing it in a down market is you essentially get more bang for your buck. You can get more shares over to the Roth IRA, pay taxes on it, and when the market recovers, you're going to get that upside growth underneath the Roth IRA.
Yeah, I guess if your IRA is down too, not that that's a good thing ever, but if it is down, you're paying taxes on less money, right?
Yeah,
if you're converting it.
Yeah, the thing is, if your IRA is down, then you have a couple choices. You can choose to implement some strategies to put yourself in a better position when things get better, or you can just kind of sit there and wait it out. Most of the time, people think you just have to sit there and wait it out. But the Roth conversion and some of these other strategies we talked about are actionable steps you can take to put yourself in a better position. Yeah, if you have the option to not do the Roth conversion when the IRA is down, and if you do nothing, your IRA eventually will come back up. But if you have this money or a piece of this money over in the Roth where now it's going to grow tax-free, eventually when this market comes back up, you get all that growth on the tax-free side as opposed to the tax-deferred side where you will have to pay taxes on that balance at a later point.
And we've been talking about some of these strategies in retirement versus while you're still working. Is this one that can go both ways, or is there a time it's more recommended than another?
This could go both ways. So it's definitely important that you consult your advisor, you look at your tax picture for the year, because it could go either way. It's going to be dependent on the income that you have, because you don't want to do a conversion if you're going to end up paying more taxes and then maybe you retire and you're in a lower tax bracket. So this could go either way. Definitely consult your planner to find out if this works well for your plan.
Yeah, priority one, make sure it makes sense from a tax standpoint first. If it makes sense from a tax standpoint, then if you can time that with a down market, then that's even better. And an additional consideration for 2022 is in the state of Iowa, they changed the tax code starting 2023. So in 2023, any retirement income, which does include Roth conversions, will be tax-free in the state of Iowa. So if you do a Roth conversion this year, you're probably going to pay some state tax on it. If you do a Roth conversion next year, then you won't pay state tax on it. That could influence your decision as far as timing on the Roth conversion. But there are a number of people, even though they know they'll pay state tax on the conversion this year, because of the down market and the discount they're getting, they're choosing to still do the Roth conversion in the down market. So it's a little bit different for everybody. The key is you have to understand, here's what would happen, here's the good, here's the bad if you don't do one, here's the good, here's the bad if you do one, and then that information helps you make your decision.
Yeah, at least, again, gives you a little control when, you're seeing these things happen around you. You have to feel like, oh, I just have to wait out the storm. Well, not necessarily. And speaking of the storm, this inflation, interest rate, stock market storm, Lauren, you've been doing this for a few years. You've been watching these things. You even kind of study the history of this stuff. And this is all kind of part of the economic ebb and flow.
Yeah, with the economic ebb and flow, it does ebb and it does flow. And we've been through this before, and we're going to go through this again. If you think about your retirement time frame, you'll probably be retired, hopefully anyway, for 20 to 30 years. And over the course of your retirement, you are going to see many recessions. If we go all the way back to 1920, there have been 18 recessions, which means on average we go through recessions every 5 to 6 years. You've seen it many times before, you're going to see it many times again. Bear markets on average take place every 2 to 3 years, market corrections on average every year. So this is not something we should be surprised about. This is something that can actually help you put yourself in a better position if you're prepared for it prior to going through this, meaning that you have a recession-resistant portfolio so your portfolio doesn't blow up when we go through these times, and you have actionable steps ready to go for when we go through these so you can put yourself in an even better position down the road. So it's nothing we should be surprised about. We should be poised and ready to take advantage of it when these times do come.
And what you guys sit down and do with families and individuals is talk about all of the options. So again, we've given you a lot of options today of things you can do to take control during this kind of a market. And one other thing that's maybe a little bit newer that, again, you're presenting people with as an option is looking into alternatives when maybe you're not getting what you want from the stock market.
Yeah, so this is a part of your investment plan. And this is what kind of asset classes do you incorporate within your overall investment strategy? The traditional diversification in your portfolio has been stocks and bonds. And people talk all the time, well, I'm about 60% stocks, 40% bonds, and that should get you through these bad times. But we have learned that is no longer the case. If we go back to the last Great Recession, which was 2008, the average 60-40 portfolio was down 26%. If we look at it during this recession, the average 60-40 portfolio is down about 26%. That's not what retirees are looking for from their portfolio.
That was not what we were going for.
And if you're 12 months away from retiring, that is not what you're looking for. So with investment technology continuing to develop, we no longer have to depend upon just stocks and bonds. There's a whole nother asset class out there called alternatives that you can incorporate within your plan. And alternatives can be a number of different things. It could be precious metals. It could be the fixed index annuity we talked about. It can be bank products. It can be commodities. There's a lot of different alternatives that you can incorporate. The key is that you have to have asset classes in your portfolio that when some asset classes go like this, others are like this, And when asset classes are like this, some have to stay like this to make sure that you can deliver the income that you need to deliver the lifestyle, the retirement lifestyle that you want, and to make sure that it's not going to disrupt the 40 years of hard work that it took to put yourself in the position you're in right now.
So whether you really like digging into some of these investment options that you have, or maybe your concern is more about healthcare or your legacy plan or long-term care, we have a great opportunity for you to start learning about all of the aspects of a retirement plan. It's a Journey to Retirement workshop. Haley, someone who goes to the Journey to Retirement workshop, attends the workshop, what will they learn?
This workshop is intended for those who are retired or 10 years out from retirement, where we take you through retirement through the eyes of a hypothetical couple. And they may have some very specific goals that they're trying to achieve, and your goals may look different, but that's okay. You're still going to get actionable steps that you can take away from this workshop.
And implement them to help improve what you're trying to do from a retirement planning standpoint. Thus far, there's 6 different components that are involved in a retirement plan. So this is not fly by the seat of your pants type of stuff. You get, on a lot of these decisions, you get one chance because they're permanent decisions. And that's why when it comes to your retirement, there's not too many people we talk to that want to retire more than once.
Right.
And if they do, it's because they want to, not because they feel like they're forced to based on some of these factors that nobody can control. So having that retirement plan is absolutely essential as you make the transition from the working years to the retirement years. And what you are looking for in all of these decisions you have to make, much of them permanent decisions, is confidence. The last thing that you want is to advance 5 years, look back and say, I wish I would have. I wish I would have made this decision. I wish I would have done this differently. You want to make the best decisions for you possible and have confidence so you can enjoy this journey to and through retirement.
The Journey to Retirement workshop information is on your screen. You can check that out and sign up for a workshop today. Lauren, in 10 seconds. So you see these things happening around you. It doesn't mean you can't retire.
It doesn't mean you can't retire. In fact, a lot of our families retired in 2020 during the pandemic. A lot of them are retiring during this downturn in the market, and it's the plan that enables people to retire regardless of the market.
We'll continue talking about all of the aspects of retirement on this show. It's Retiring Today, and we thank you for watching.
Biking, boating, relaxation? What's your retirement vision? Learn how to take the money you've worked so hard to save and turn it into the retirement of your dreams during our Journey to Retirement workshop. Like getting ready for a trip, getting to and through retirement takes a roadmap. This workshop is the first step to planning your 20 or 30-year vacation. Go to retirewithmerkle.com to register for our Journey to Retirement workshop this week.